Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. With so many financial alternatives available today, investing may seem complicated and overwhelming to some investors. It's good to remember that buying dividend-paying stocks and looking into fresh tactics for higher returns are worthwhile approaches. Many investors enjoy delving deep into the complexity of different investment opportunities, such as dividend stocks and cutting-edge tactics. But sometimes keeping things straightforward is the best way to go. Simplicity has its place, particularly in retirement savings. Here's a simple yet effective approach that many investors are doing for their own retirement savings: owning the S&P 500 index. Warren Buffett, one of the most successful investors, has long recommended people to buy and hold the S&P 500 index. Investing in S&P 500 index is very passive. Fees for the S&P 500 ETFs are the lowest you can find, and most importantly, the S&P 500 index has on average returned 9.5% per year over the last 30 years. So it is a great investment option to generate wealth. But today we are going to take it to the next level, so to speak. By implementing a small tweak, you can potentially double the wealth. Sounds too good to be true? Give the video a like and subscribe to our channel, as we will show you how it works right now. Once you have S&P 500 shares in your portfolio, keep investing regularly, whether it's every week, month, or whenever you can add to your holdings. Keep buying more shares at regular time intervals, no matter what's happening in the market. You are essentially averaging your cost of purchase, and it's a trusted choice that's stood the test of time. Next, once you have at least 100 shares of the S&P 500, consider selling covered calls on your portfolio. If you sell out of the money call on S&P 500, you will receive a premium upfront. When the option expires, if the S&P 500 index does not exceed the option strike price, then you basically get to keep all the option premium yourself. You can then reinvest the extra income back to buy more S&P 500 shares. This method offers a good way to earn extra money from stocks you already own while keeping your investment relatively safe. More importantly, with the extra income generated from selling options, you are buying more S&P 500 shares throughout the year. Gradually but surely, you will grow your portfolio bigger and generate wealth faster than just holding S&P 500 shares. You can choose how often to do this, whether it's every week, every month, or even every quarter. We are going to demonstrate this idea by showing you an example. Let's keep it simple and focus on selling out of the money covered calls on the S&P 500 on a monthly basis. Right now, as in September, SPY price is $444 per share. Now, we want to generate income by selling options, but we don't want the options to be called away by the time it expires. In other words, we want the options to expire worthless in order to keep the income generated. We pick a strike price that is 5% higher, which is equal to roughly $466 a share. Let me break down the steps with the calculations. 1. The current price of SPY sits at $444, and you expect SPY return will not exceed 5% for the month. 2. To calculate the target strike price, you multiply the current price by 1.05, that is 1 plus 5% expressed as a decimal. So, $444 times 1.05, which equals $466.20. We will round it to $466 for simplicity. This is the strike price for the out-of-the-money option you will sell. 3. Selling a covered call. You would sell a covered call option with a strike price of $466. From the SPY option chain, you see such an option is worth 32 cents per share. Note that one option contract is for 100 shares. So you could generate $320 income by selling one SPY call option with 1 month to expiration and strike price at $466. 4. Potential income. By selling this covered call, you receive an option premium. If the price of SPY does not rise above $466 by the end of the month, the option expires worthless, and you keep the premium as profit. You can then repeat this process every 30 days. By following this approach, you generate option premium income, which you can reinvest in more SPY shares. In this particular scenario, if you've managed to generate $320 from the option premiums, you could utilize this amount to buy more shares of the S&P 500. Nowadays, you can actually buy fractions of a share, so that makes reinvesting the option income very convenient. By following this approach, you'll keep on selling out of the money covered calls, guaranteeing a growth in the worth of your investments over the next 30 days. Furthermore, if we hypothetically assume that you consistently write covered calls with strike price 5% above current market price, generating roughly $300 in premiums each time, without regard to your initial investment or its basis, the result would be an approximate annual addition of $3,600 to your investment. This can significantly increase the number of shares you own over time, potentially boosting your retirement income when the time comes. Let's look at two more charts. The first chart shows a projected portfolio value over time of an initial investment of $50,000 into the S&P 500 index, doing nothing afterwards, and just to let it grow for 20 years. Here we used an annual return of 8% for the S&P 500 as an estimate. In reality, the S&P 500 has returned about 9.5% per year over the last 3 decades, so we are on the conservative side here. Anyway, after 20 years, your portfolio grows to $233,000. Now, if you use the $300 generated from selling options to buy additional S&P shares every month, what will happen after 20 years? $300 per month isn't a big number. It is not even enough to purchase one S&P share, but as long as you do it consistently, everything else being equal, your portfolio at the end of the 20-year period will almost double to $400,000. Isn't that amazing? And if you think about the strategy, the extra $300 is not coming from your personal savings. You can generate the money with the option premiums. If you noticed, in the example earlier, I chose the strike price to be 5% above the current market price of S&P 500. I should note here that as an investor, you need to decide how out of the money the option strike needs to be. While a lower strike price can generate more income from selling the options, there is also a higher likelihood that actual S&P 500 index will reach that level by expiration. If that happens, then you are obligated to sell 100 shares of the underlying asset, which is S&P 500, at the strike price, so you end up with less S&P 500 shares in your portfolio. Because our goal is to generate wealth through S&P 500 over the long term, we should try to keep as many shares as possible. So I think a monthly 5% return could be a good balance of how much income can be generated as well as the likelihood of hitting the strike price. The 5% monthly return is not a hard rule, and you can decide how much out of the money the strike price should be, but here is a chart showing S&P 500 index monthly returns from the year 2000 to July 2023. Out of 282 monthly data points, there are 38 occasions where the S&P index returned more than 5% in a month. That translates to a probability of 13%. What this percentage means is that if you sell an out-of-money option that is 5% above the market price, you could expect to keep the premiums for 7 to 8 months, following 1 month where you would be obligated to deliver S&P 500 shares at the strike price. Remember, regardless of your choice, at the end of each period, you either let the option expire, buy back the shares if assigned, or roll over the option for a credit. This strategy can significantly increase the number of shares you own, ultimately leading to greater income potential for your retirement. So, here is the simple and stress-free path to retirement dreams. No complicated formulas, no risky bets, just a simple and easy strategy that can pave the way to the retirement you deserve. Remember, a secure retirement doesn't have to be a distant dream. Regardless of your age or savings, it is never too late to start the first step. And if you've enjoyed this video, don't forget to give it a thumbs up and hit that subscribe button for more awesome content like this in the future. Thanks for hanging out with us, and as always, I'll catch you in the next one.